Jim Juback, and welcome to my YouTube video for Thursday, February 15th. Well, here in Venice, which is where I am, not Toledo, Ohio, or Spain, Carnival is finally over, and I have to say that my favorite costume, it's 10 days of parties and people dressing in costumes and parading around. My favorite costume is one I saw maybe on Tuesday, so very close to the end, or not, maybe Monday, and it was a woman with a baby stroller, and she just somehow managed to get that stroller down over the big Rialto Bridge, shoop, shoop, 50 steps up, 50 steps down, bump, 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 bump. It's like something from Potemkin, Battleship Potemkin. Einstein would love to shoot Mardi Gras. Carnivale. Anyway, she was dressed as a unicorn, I think from one of her kids' books. The stroller had a unicorn's horn also on it and was dressed in pink tulle. There was a baby in it. The mom, however, not only had the unicorn, but she had 4-foot tall blue wings. Just the most amazing thing I've ever seen. And of course, there was a small poodle also dressed in tutu, but that was my favorite costume. Okay, so from that reality to a different one, the Federal Reserve. Today's topic is inflation, stickier for longer. Basically, the market is looking at this and going, does the Fed have like a last mile problem? Before we get to that, if you like this video or find it useful, please subscribe to my YouTube channel. And it's free and you just get notification when we do our next one. You can also get my free site, that's jubackpicks.com, 3 portfolios, a couple of posts a day, or my paid site, which is 2 to 4 posts a day, 6 portfolios, including some options and really long-term and ETFs. And you can find links to all those down below. Plus, as I mentioned at the beginning, I'm in Venice. I've moved my operation and my life here for a little while. And if you'd like to follow our exploits, that's my wife and myself, you can, we started the Substack, which is also free. It's called We Moved to Venice. It's called We Moved to Italy, and you should find a link to that down below. We'd love to have you join us on our adventures and comment and make us feel like we're in contact with people at home. Anyway, so topic, as I said, was inflation, stickier than expected. Market thinking that the Fed has got a last mile problem. CPI numbers, the Consumer Price Index numbers that came out on Tuesday, weren't terrible. Headline inflation, that's all items inflation, was 3.1% annual rate. Core was 3.9. Remember, we were once back at 9% inflation, so this is really, really good from there. The problem is that economists looking at this ahead of time were expecting that headline inflation would drop to below 3%, 2.9, and that would show that we're indeed marching steadily toward the Fed's goal of 2%. Instead, we got 3.1, and basically investors, Wall Street said, hey, maybe it's going to take longer than we expected to get down to the 2% target that the Fed had, and maybe we won't get the rate cut as early as March, which at one point, back in January, it was virtually a guarantee. The odds of, according to the CME FedWatch poll, of there being a rate cut in March, the March 20th meeting, were something like 90%, according to investors in the traders in the Fed funds futures market. Now that's in this morning, so the 14th of February, the odds of no action in March are almost 90%, almost a complete flip. May odds of no action are 61%, so only about a third of the market is thinking that we're going to get a rate cut as early, and now the market is starting to price in June with a 80% chance of a cut, July with about a 94% chance of a cut of one time or more. So we've moved the whole calendar back, and one of the reactions to that yesterday was that bond yields went up. So we're back around, where are we? Back around 4.3% on the 10-year, 2 years at 4.68. That's sort of retrace of almost all of the drop in yield from the Powell pivot. Powell pivot. Ah, look on the clock. Time is money. And stocks went down on this too. Now, the question is, was January just a blip in this, and is the path really going to be smooth from here on down to 2%? There is good reason to believe that inflation is sticky. First of all, it's a really interesting index out of the Atlanta Federal Reserve Bank. They look at just those price categories where prices tend to be sticky, and they do an index that looks at how much of that is feeding into the inflation rate right now. And what they're seeing is that those sticky prices are indeed being a major driver of inflation not coming down as fast as we expected. That we're seeing sticky prices, in fact, go up. They've been going up month over month for the last 3 months. That has pretty much ended a pattern of down over the last year. So that's one thing. Second of all, is that if you take apart these numbers, it looks like what we've seen is a big drop in goods inflation. The price of things has come down very strongly, but the price of services has not. In fact, if you take a look at something, there's another take on the inflation number that's called the super core. So it's not just core inflation, which takes out energy and food prices, and that ran at about 3.9% annual rate in January. But this takes out another segment. It takes out housing. And housing is very, very contentious right now because the housing numbers look wacky. So maybe they're adding extra points to the inflation rate that really shouldn't be there. But if you look at the supercore rate, which takes out energy, food, and housing, and just looks at services without those elements, the drop in inflation in the supercore rate has stalled. So again, we're seeing if you look below the surface of the numbers and below hopes that maybe January inflation numbers were just a blip, we've got good evidence that says, hey, this last mile, this last step from 3% down to 2% is going to take a while, and that maybe March is out and May is out, and maybe looking at June or July. And then the question comes, the market's going to be disappointed. How much does that get reflected into prices? My guess is that the market is going to be disappointed, but basically we'll get over it without too big a kerfluffle. So I'm not looking for anything more than maybe a 5% drop here as we readjust the calendar. But that's about it. But I do think indeed we are going to take longer to get down to the place where the Fed can start cutting rates than everybody expected back in January, a long time ago. Anyway, if you like this video, please subscribe to my YouTube channel. That way you get notification when we do our next one. We're doing about 3 a month. If you want to see more of my posts, written form, and 3 portfolios for 5-year, 12 to 18 months, and for dividends, you can go to my free site. That's jubakpicks.com, usually 1 or 2 posts a day, or subscribe to my Jubak AM site, jubakam.com, and that has 6 portfolios. We do some options, ETFs, some really long-term, what I call my millennial portfolio for people who have a really long time horizon. Also, if you'd like to follow my adventures in Italy, I've moved lock, stock, and caboodle to Italy for a while, just, hey, because you can these days. And being in Venice is really a lot of fun. And after Venice, we're going someplace else. So after May, we'll be in another part of Italy. We haven't quite decided where. It's a surprise. But you can follow us, again, for free. It's the internet, of course, everything's free. Substack called We Moved to Italy. We'd love to have you along for the ride. Subscribe, you'll get notification when we do our next post. And you can comment, and if you've got stuff that you want to throw in, like, hey, my favorite restaurant in Venice is, or gee, you really ought to go to, please comment. We'd love to hear from you. Thanks very much for watching.